All right. Hi, everyone. Thanks for taking the time out of your busy day to join us this afternoon. My name is Josh Siegler, and I'm a principal here at One Roundtable Partners and 10T Holdings. Welcome to Building on Blockchain. The goal of this series is to host fireside chats with some of the most influential and important builders in the digital asset ecosystem today. It's the bridge between the old world to the new world. Sometimes it's easy to lose oneself in the daily price action of crypto tokens or the endless headlines that fly around the space. And boy, oh boy, this was certainly a week for many headlines. Trust me, we'll be addressing some of those, especially around the election outcome, as we progress through this call. But, sometimes it's good to take a step back. Behind the complex acronyms, the memes, and the day trading are real companies building real products with some of the most disruptive technology available, blockchains. These builders are ushering in a new paradigm, a more efficient world with decentralized trust and broader opportunity for all. Something we spend a lot of time here at 10T, 1RT is figuring out which sectors of the old world are most likely to be disrupted by blockchain technology. I think the easiest use case for most investors and participants to wrap their heads around is financial services. I've covered traditional fintech for years on Wall Street, and I was always surprised about how much inefficiency there is in our core financial systems. Well, some builders are using blockchain technology to try and change that. And one of those companies, of course, is our portfolio company, Figure. So I'm joined here today with Mike Cagney, co-founder and CEO of Figure Markets. Mike, thanks for joining us today.
Thanks for having me.
Of course. We have some questions prepared for the next 30 to 45 minutes that we'll be going through to really dive into Figure and understand it from a core basis. But that being said, if any investor or participant on the phone right now has a question, you can submit it in the Zoom Q&A box below. Now, Mike, I could wax on and on about your many accomplishments, but I think the audience would rather hear from you directly. So I'll turn the floor over to you. Perhaps we can start with a brief introduction for those who might be unfamiliar with your background.
Sure, and I'm going to caveat with I'm overcoming laryngitis, so I'm going to power my way through this discussion as best I can.
We
But
believe in you.
apologize for the raspy voice. So look, I started way back in the late '90s at Wells Fargo. I built their structured product group and product development group, and ultimately their proprietary trading business. And was very focused on markets as part of that. I left in 2000 to do my first startup, which was a wealth management technology that ultimately got sold to Broadridge. And I left that and went in and started a hedge fund. And as I was working in the hedge fund and kind of going through the financial crisis, the 2008, 2009 period, I started thinking a lot about the intermediation of capital. So, the sources and uses of capital and the entities that sit in between and the amount of rent they extract to sit in between those sources and uses. And so I was watching someone, Chris Larson, who was building a business prosper. And I'd known Chris from Elon when I was doing my first startup. And what he was doing with Prosper was super interesting. And this whole idea of connecting people, people with money with people who need money. And I said, well, this is really cool. And on the back of that, ended up launching SoFi with some of my co-founders. And the original intent behind SoFi was that we were going to disrupt banking. We were going to create this disintermediated ecosystem. And obviously, SoFi's been extremely successful, but it didn't disrupt banking. In fact, it is a bank now. And so in 2017, late 2017, I left SoFi and I started thinking a lot about what really could disrupt financial services. And I had sort of my aha moment with blockchain when, up until that point in time, I'd been given Bitcoin a lot of time and focus. And, I didn't really truly understand blockchain per se. I understood Bitcoin in a construct. But I spent a bunch of time looking at the blockchain technology, and I realized if you can displace trust with truth, so you can create a native digital asset where you know for certain its ownership, its composition, its history, and you can transact that asset bilaterally without counterparty or settlement risk, it introduces a really interesting construct, which is creating agnostic marketplaces, right? And excuse me, in particular, you think about everything in financial services, everything's an intermediate market. So we trade stock, there's 7 people that sit in between a buyer and seller. You swipe a debit card, there's 5 parties that sit in between a buyer and seller. And so if blockchain had the ability to distill that down to just buyer and seller, our view was that that was huge and disruptive and something that we wanted to lean into. And so that was really the genesis of Figure and why we started the company.
Absolutely. Removing all that additional counterparty risk that we see way too often in most of our financial services. Now, Mike, I have so many questions about Figure and what you've been building. But before we really begin and dive into that, I'd be remiss not to mention the massive elephant in the room, of course, the election. A pro-crypto administration will be entering the Oval Office starting next January. Like, I'm curious kind of how you're thinking about the future of digital assets, perhaps both from a regulatory perspective and a reputational perspective.
Yeah, I mean, I think that we need to be cautious about how fast change happens, because in particular with the regulatory agencies, while the chairperson may change, the staff is the same.
Hmm.
So, the person who's run trading and markets, the SEC today, was the same person who ran trading and markets under Trump and who also ran it under Obama. And so, you need to be a little bit pragmatic, but I think there's a couple areas of encouragement, and it's not so much out of the SEC, it's more out of the banking side. So I think, changes at the FDIC, a permanent director at the OCC, um, a change in direction, or at least a modest change in direction in the Fed, could really allow the banks to start leaning in more on blockchain. So, we do a bunch of work in Figure and capital markets, and we interact with a lot of some of the very largest banks, and they have to get special exemptive order to be able to work with us through the Fed. They can't talk about it publicly. There's all these limitations. And I think that transparency is going to open up, and people are going to realize that there's actually a lot more activity happening native on public chain than people thought. And the reason it's happening is because it makes economic sense to do it. And so, we certainly said going into the election it couldn't get any worse, and I think coming out of this it could get better.
Yeah, absolutely. I think, more of that old world embracing the new is a theme that we're going to see definitely start playing out more and more. I think, we're even seeing it from some of the largest big banks. JP Morgan just renamed their Onyx platform recently. So we'll see how that continues to, play out moving forward. But let's bring it back to Figure for now, right? So you're on the forefront of really addressing some of these gaps in the market. So when you thought of the idea for Figure in the first place, why did you focus on HELOCs and what were you really trying to solve for in those first couple of years?
Yeah. So, and excuse me for coughing. So what we tried to do with Figure initially was we had a thesis that we could use blockchain technology to cut effectively 70 basis points or 85 basis points of cost out of an asset origination, aggregation, and securitization process. And we went to a bunch of banks and I pitched this idea. And the first issue was, well, the technology is not going to work because at the time it was predominant proof of work. This is 2018. And the proof of stake networks that were coming on had the issue that they function like golden data sets. So if I put a loan on a proof of stake network, it went out to the validator, all the PII, all the customer information. Obviously, you can't do that. So we made a blockchain called Provenance, which is a public, open source, decentralized proof of stake chain. And it has this unique characteristic that when I put an asset on there, so one of my loans is 5 gigabytes of data. I put that on provenance. What actually goes to the validators is a 256 character of that data. So the data goes into an encrypted object store. And that allows the blockchain to function as a data validation agent, but not as a golden data set. So I went to a bunch of banks after that and I said, look, I've solved the technology problem. I have the right public blockchain for you to do. And the university, the banks are like, this is awesome. We love it. We'd like to be the 10th bank to do a securitization of the blockchain. And so it was clear there was no appetite to be early mover. And I said, all right, well, I'll be the early mover. I will start originating assets. Excuse me. And in doing so, I didn't want to go into a situation where I had to compete on the asset origination side and convince the buy side to start using blockchain. So I found what I thought was the greenest field possible, which was HELOC. And I said, I can do a much better product here than what's in the market. And that will be a forcing function for the buy side to lean in and start participating. And that worked very effectively.
Understood. So let's talk a little bit more about provenance, like building your own blockchain. We throw this term around all the time, and it sounds so easy, right? Just build a blockchain. But what was that process actually like for you from the ground level, and how do you think about it from like a resource standpoint as well?
Yeah, well, June and Matt built Provenance, so I didn't have to be that involved in it. So, June's the president of Figure, or was the president of Figure, now president of Figure Markets, and Matt was the CTO at Figure, now the CTO of Figure Markets. Um, but it was an interesting activity, notably that we never really leaned in on the crypto degen native community as it related to Provenance. We were very focused on traditional financial applications that generate real economic value. And what's happened is, we've now done probably $40 billion real world asset transactions on Provenance. I think there's 15 or $16 billion of locked TVL of RWA on Provenance, which is by far more than anything else in the marketplace. And Figure's putting another $600 to $700 million a month on there, new assets, and building into a really interesting ecosystem that we'll talk about soon. But it's been a rewarding process. What we're doing now is we're kind of shifting gears. We're saying, you know what, we are going to bring this story to the native crypto community because this is the only real RWA story, the only sustainable one where there's real economic value coming out of it.
Yeah, understood. And we'll be talking a little bit more about kind of that end result, but I want to just stick on, the technology side for just another question or two. And it's really around, understanding the benefits of building out your own chain. Um, we often compare some of these new products and new companies to the traditional peers. So let's do that. When thinking about a traditional bank, how does Figure's solution, especially on Figure lending side, how does it differ because it's using this blockchain technology from an end user perspective?
Sure. So from an end user perspective, so if you apply for a Figure HELOC, you have no idea there's a blockchain behind it. And
Hmm.
that's how it should be. What's happening and where some of the economic benefits are coming from, the way that the assets are originated, they're completely homogenous. There's no underwriter, there's no processor, it's all digital. And we can feed that digital data directly into the blockchain, and the immutability of the blockchain provides a significant economic benefit. So every mortgage securitization since 2008, 100% of the loans get audited. It costs $500 a loan. Our deals to get AAA, it's 20 to 30% of the loans, and it's $100 a loan because of how we use blockchain, because of the immutability of that data. Where it gets real interesting downstream is the ability to perfect assets on chain. And we'll talk about that in a few minutes. But it's the key for this is you don't want to be using blockchain for the sake of blockchain. And there's been too much of that. So if you look at a lot of the blockchain activity that happens out there, it's incented through token incentives and other, non-market incentives to get people to use it. On Provenance, we use it because we save over 100 basis points of cost, and it gives us a massive moat competing with anyone else in the ecosystem. And that's why Figure is the largest non-bank lender of HELOC. And soon we're leaning in with our partners into first lien mortgage. And the key for Figure is we shifted early on. We started off direct to consumer. We sold loans to individuals. And today, most of our production is across 130 third parties, 10 of the top 20 mortgage retail shops, for example, that use our tech to originate assets. All those assets are on chain. They don't see it as blockchain, they see it as technology, which they should. But the blockchain is providing a huge economic value on the construction process, and ultimately will downstream on the trading and leverage process as well.
Yeah, so to that point, the cost benefit is absolutely enormous, and obviously you found great success with this. So, Mike, I'm going to ask you now to put on your old TradFi hat. Imagine yourself at a Wells Fargo, at a Bank of America. Why have they been slow to innovate and really adopt this technology? And why has that created so much white space for you?
I think there's a couple of reasons. One is it had a regulatory headwind. So, the Fed and the FDIC have been very, limited in terms of what you can do on public chain. And there's a lot of these spurious private chain activities that are going on out there. private blockchains are useless. They're no better than a data set or a database, I should say. And the fundamental reason is this ability to displace trust with truth. And what the second aspect of this is, there's a network effect that has to occur. There's a starting function that has to occur. But here's where the real opportunity is. So I've talked about efficiencies, and there's certainly efficiencies that come out of blockchain, and the ability to reduce costs, for example, in our situation, and use it as a competitive moat. But here's where the real opportunity is going to come. If I'm a sovereign wealth fund, let's say I'm Temasek or GIC, right? Two that we're very close with. I have an issue in that I have a real estate silo, an equity silo, a private silo, a credit silo, and these silos all live alone and they're not cross collateralized. And so, if I could cross collateralize those assets, I could probably deploy twice as much capital without any incremental risk. But I can't cross collateralize them. And further, within those silos, I'm limited to whatever the prime broker is willing to lend against to my name as credit, right? And so many of these sovereigns are full on credit. They can't borrow any more money because they're credit full at the sell side banks that provide that service. So imagine a blockchain world. Imagine a world where all of these assets are digital assets. You can perfect immediately that asset on chain. So I can effectively encumber it. I can run 24/7, 365 margin into it. And now I can start looking across all assets. I can look at your equity, your fixed income, your crypto, right? And I can think of this as effectively an asset-based loan. And I don't have that relationship to you anymore. And so the cross collateralization opens up or unleashes an enormous amount of capital that can come into the market. The issue is you have to finance that. And the prime ecosystem isn't set up to finance that. And so, what blockchain, I think, will usher in is what I call democratized prime, which is anyone with money can lend to anyone who needs it on an asset perfected basis where the counterparty is irrelevant. And this is, in a microcosm, what we do with crypto backed loans, right? I lend people money against Bitcoin. I don't underwrite their credit because I don't care about their credit. I have 24/7, 365 perfection of the asset. If it hits 90 LTV, I liquidate them out. I've never lost a dollar lending against crypto. My HELOCs are phenomenal, awesome credit performance, but I've lost a couple of dollars on those, right? But I've never lost a dollar lending against crypto because of that perfection. And so that ecosystem is what I think we're going to move into. That's massively powerful for not just the investors. The banks play a critical role in this in terms of contributing capital, but it opens up anyone's ability to lend capital and not have to do it through a prime broker intermediary.
Yeah, I think that point is so important. And it kind of ties well into my next question, which is really around the tokenization. As you mentioned, with blockchain proliferation, if securities become truly tokenized, we can imagine the world looking very different. Every TradFi crypto event you go to has like 6 panels on tokenization. There's a digital asset head at all these asset managers and banks who's working on tokenizing. But what stage do you think we're actually in for RWA tokenization today? And how is Figure positioned to capitalize on that?
So most of those RWA discussions are useless. And I'm going to piss off a bunch of people for saying this, but the reality is, if it isn't a native digital asset on chain, there's really no value prop of using the blockchain. So for example, if I want to tokenize a DTC security and put it on blockchain, why would I do that? Because I don't actually know that that security is, in fact, the security. I don't have a perfected interest to it. There's much better and much more efficient mediums to trade than blockchain. Blockchain is not a great technology to run order matching, for example. And so the only value of blockchain comes when the asset is made on chain, and that is the perfected asset. So, the idea of putting an office building on chain, unless you put the title on chain, it doesn't make any sense. Putting art on chain, I talked to somebody the other day, wanted to put sneakers on chain. And I'm like, well, how do you know the sneakers didn't burn up? How do you know someone didn't sell them to 27 other people, right? If you lose that truth and you go back to trust, you're back to a point where you need intermediaries in the market. And so what the industry has to focus on is creating native digital assets to chain. And this is where I'll say probably one of the more controversial things. The tokenized money funds are not real world assets because the assets that live in those funds don't live on chain, right?
Mm.
When they do live on chain, we're in a totally different paradigm. But right now, it's just a representation of something that lives off chain. You have to trust those assets are really there. And the point of blockchain is you shouldn't have to trust anything. And
Mm.
that's really what we have to get to. And that's why I figure, we don't create loans and tokenize them. The loans are on chain. And what we're trying to do with public equity now is we're trying to bring public equity native to chain, not tokenizing a DTC security, but having the registry be the blockchain. And what we're doing with Figure on the other side with the asset-backed securities and the TBA market and everything that's being set up, those will all be native on chain. And so if you're native on chain, now you have the ability to cross collateralize and you have the ability to get true perfected interest.
Yeah. And this is what I find so interesting is that native on-chain future, right? It kind of juxtaposes how you approach the consumer, which is not mentioning on-chain at all, right? If I'm on Figure Lending's website, there's practically no mention of blockchain technology available. Is that the future for, how we start using this technology, where it's just really in the background supporting more of these consumer applications?
Yeah, I mean, I'd say that a lot of people today who trade crypto think they're trading on chain, and obviously they're not. Coinbase and Binance are not
Yeah.
on chain trading venues, right? I think the experience for the individual and what I think is going to happen, if you look at like Robinhood experience right now, going from equity to crypto is very disjointed. You're in two completely different situations. You're in a different application. I think what needs to happen is effectively an integrated experience on the front end, a cross-collateralized experience on the front end, where you manage the regulatory requirement and segmentation of capital on the back end. It's transparent to the user, or obfuscated, I should say, to the user. And so in particular, like I want to bring public equity on chain, including my own cap table. I want you to be able to take Figure stock and use it as collateral for a Bitcoin perp. I want you to take Bitcoin and borrow against it to buy Figure stock. And I don't want it to be a disjointed process where you're physically moving cash from one wallet to another. I don't want you to think about a wallet, right? I just want you to think about an account. And
Hmm.
so that's what we have to get to. The UI UX in crypto land I remember there's a tweet Frank Robin did a couple years ago about how bad it was, and he's right. It's just not at a level that Web 2 is in terms of front end user experience, but it can get there. And I think you're going to see that happen over the course of certainly 2025.
Yeah, absolutely. Now we're about halfway through our discussion here. So once again, if you have a question, please submit it in the Zoom Q&A box, and we'll try to get to some of those near the end. But Mike, I'd like to, shift our focus now and talk a little bit more about Figure Markets. I want to give this, plenty of time here. So, recently you've worked on developing an exchange aggregator with that decentralized custody, solving a lot of the problems that we were just discussing. And that's a separate product than Figure Lending as it exists today. So why, launch Figure Markets? What was the rationale behind it, and how do you see it trending in the future?
Yeah, so Figure, and we don't call it Figure lending because it's as I said, not so much of a lender anymore as a marketplace operator. But so the flagship Figure
Mm.
is very focused on standing up an ecosystem that looks like a GSE ecosystem, like a Fannie or Freddie, for initially for private credit, but ultimately for conforming mortgage as well. And they're making a lot of headway into that. And that business is, it's been doubling every year. It's very profitable. Our hope would be it goes public sometime in the future. And it made sense to spin off Figure Markets, which is more of a 0 to 1 effort. And with what we're trying to do with Figure Markets is basically build the exchange for everything, right? And so what we have is a bunch of the regulatory infrastructure. So I have an alternative trading system that I can trade blockchain native securities on. I have the money transmission licenses. I have, Cayman VASP and derivative license. So I can run both U.S. and global exchange for this. But what I'm not trying to build just a crypto exchange, right? I'm certainly doing crypto, but I'm trying to build, public equity, fixed income, credit, everything else I can put onto here. And the key for this and why I started with crypto, very analogous to like, why did I start with HELOC? Because it was greenfield. Well, exchanges have a chicken and egg problem. You need people on to trade assets that then beget more people that beget more assets. And to me, it was amazing that after FTX, after Celsius, after BlockFi, Binance and Coinbase still work the same way. There's still centralized custody, centralized clearing, centralized marketplace. You have the exact same exposure with those two firms as you did with FTX. And so I went to a bunch of custodians, when I started Figure Markets late last year, early this year, and I said, "Hey, look, I want to build a decentralized exchange." And they said, "Oh, it's awesome, Mike. We'd love to help you. We'll just hold the crypto and tell you it's there." And I was like, "Well, that's not really decentralized. That's just moving the centralization to you." And so we started looking at multi-party computation wallets. And these MPC wallets are really interesting because the inherent problem you have in crypto is we have all these different level one blockchains. We have Bitcoin, we have Ethereum, we have Provenance, and they're not cross compatible. Like a Bitcoin can't live on Ethereum, and a Provenance loan can't live on Ethereum. And so what the exchanges do is somewhat logical. They're like, well, just give us all your stuff and we'll represent it on an exchange and you can trade it. But in doing so, they have possession of your stuff. And so what MPC does is in very simple terms, allows us to shard the key to those assets and create a security entitlement to one of those shards and trade that on an exchange that allows us to not just represent perfection, but cross collateralize and all the other things that we want to do. And so we, in August, stood up an MPC backend US exchange, and in September, an MPC backend global exchange. And it's still not feature complete. We're adding products, we're adding leverage, we're adding perpetuals. But what I'm really focused on is getting Figure's ABS market on there, getting public equity on there through, our own equity plus the activist campaign we're running on Ionic right now. Getting things like our REIT and Apollo's REITs on there and providing secondary liquidity there. So there's a lot of objectives that we have to build that out and really start demonstrating that virtue of cross collateralization and that opportunity of democratized prime brokerage.
Yeah, absolutely. There's been a massive proliferation of new chain launches, right? And we've seen immense fragmented liquidity kind of follow that. It's really hard to operate in this multi-chain world nowadays. So I'm also incredibly bullish on MPC and the future of decentralized custody alongside that. But, I have to do my job here as the moderator and play devil's advocate sometimes. So, we get a lot of pushback in the DeFi or decentralized world that where critics are saying that technology always trends towards centralization over time. We've seen that play out in multiple sectors with a lot of players enter and only a couple win. How do you respond to that view and in the centralization versus decentralization debate?
Yeah, I mean, I think it fundamentally ties down to the biggest benefit that blockchain can give us. There's certainly operational benefits that we get, like at Figure, the 100 basis points we save originating assets. But that's insignificant to what the real benefit is, which is cross collateralizing assets and providing effectively a democratized way to finance that cross collateralization. And to do that, you need to have true perfection, true knowledge of truth, right? And you can't do that in a centralized construct. You can't. This is why a private blockchain doesn't make any sense, because there is no value add it delivers, because you have to trust the operator or runner of that chain. And so in a public chain done the right way, you know that asset is what that asset's represented to be. You have perfected interest to it. You can liquidate it 24/7, 365. And that's what unlocks not billions, but trillions of dollars of capital. And that's really what we all need to be aiming for on blockchain. That is the holy grail. That and payment rails. And we can talk about payment rails as well if you want.
Oh,
But
I could
those
talk
are
about payment rails all day with you, Mike. But before we do get there, do you think there's still an educational hurdle that has to happen on the other side, right? Where it's we see so many consumers who are first dipping their toes into this space, just content to leave their Bitcoin they buy on Coinbase, right? And never think about the DeFi impact that they could have by moving it on chain and really taking advantage of that world.
Yeah, and it's really around, the feature complete aspect of it. So if you could easily borrow against your Bitcoin, for example, at a lower rate than a credit card rate, and with no friction at all, you'd start thinking about, well, where should I have that Bitcoin, right? I don't do that on centralized exchanges. I can do that on decentralized exchanges. I think the real initial people that are going to lean in on this are going to be the big institutions. I think, the Apollos of the world, the sovereigns, the GICs of the world, right? GIC is limit full with prime broker. So if you can bring them a solution where they can take that collateral they have and turn it into cash and not be full on single name exposure, they're going to lean in to do that. And that's going to create a lot of liquidity and that's going to attract a lot of participation. And one of the promises about blockchain and in particular decentralized exchanges is it's a level playing field, right? The whole Binance tier 1 through tier 9 is completely orthogonal to the spirit of crypto. Like everyone should trade at the same price and that's the best price, right? And everyone should add transparency to it. And so I think you're going to see some of the big industry leaders start pushing more and more activity on chain. And I think that's going to crowd in retail behind it.
Yeah. And to that point, when I think about especially retail entering, I see the two use cases that jump off the screen immediately. It's really, for me at least, payments and lending. And we've talked a lot about lending. Would love to hear a little bit more about, how you're seeing the demand right now for digital asset liquidity and those lending services develop.
Yeah, so the issue around payments is, payments is predominant. The bulk of the economic on payments is in the US. And the problem that you have in the US is our payment system is a five-party interchange system. So you have an issuing bank, an issuing processor, a network, which is Visa or MasterCard, a merchant acquirer, and a merchant bank. And the merchant bank is often the merchant acquirer. And the problem you have is you have at least two, if not three banks in that five-party ecosystem. And currently, none of them can touch crypto. So, the question is, why isn't USDC a payment rail? Well, because no bank can touch USDC. And the integration of payment infrastructures starting at point of sale is so sticky into existing US merchants that it's not a trivial thing to bypass it and go through a blockchain loop. And so what we've been doing and what we've been focused on is a public security that has a fixed dollar price and pays a continuous yield. So it looks like a money market fund, but it can't be a money market fund because if it is, money market funds they require a regulated venue to transfer. So they need to trade on an ATS or on the National Securities Exchange, and the SEC won't approve that right now. So we, about a year and a half ago, almost 2 years ago, we started working with the SEC, and about a year ago, we filed an S1 for a security called Yields, and it's public. It's done under Figure Certificate Company. If anyone wants to look it up on Edgar. And what Yields is a unique security called a face amount certificate, which is effectively the only kind of public security that's freely transferable peer to peer. So I can take $50 from my wallet, move it right to your wallet, and I don't need to do it through an exchange. And so after a lot of back and forth, today we just published the exemption order for Yields. So it's out for 30-day comment. But we would expect we're at the end of that process. And we would hope that in the not so distant future, we will have a public security that pays a continuous yield. So for minus 50, freely transferable peer to peer, that I think an enormous amount of capital is going to go in to build payment infrastructure, cross-border remit, a bunch of stuff around that.
Mhm.
And we're super excited about it. And that, and because it's a public security, it's not crypto, banks can hold it, right? It's not a limit. So it can work within the existing payment rails. It could work outside those payment rails, but we're finally getting something that I think you can build a new disruptive payment ecosystem around, and it's imminent in terms of, well, at least I hope it's imminent in terms of coming to production.
Yeah, absolutely. It sounds like a fascinating product. And to that end, I think when we talk about the payment process as it exists here in the United States, it's hard to see where disruption would really come in just because it's so ingrained in, pretty much the whole economy at this point. But I often think about cross-border remittances, which is, where you alluded to, where the pain is felt on every single transaction, where it can take multiple days, cost so much money to send,
Yeah.
fiat
Yeah.
overseas.
Yeah,
So I
you know
think that's
it's
naturally disruptive.
yeah, you know it's crazy. You know those Coinstar machines, the ones you
Yeah.
take your change and they give you. So they sell Bitcoin, and that's actually the predominant reason people use them these days. Is they go there, they buy Bitcoin, and they move it to their relatives outside of the U.S. And so you think about how much friction's in that transaction, and that's still better than the alternative,
Yeah.
right? And so if you could do something like yields, which is effectively it's not a true bearer asset because it has a transfer agent, but effectively it's cash. That become that really reduces the friction, it reduces demonstrative funding, it reduces all the stickiness that we have on cross border remit, and I think really will provide some revolutionary disruption there.
Absolutely. So we have some questions coming in from the audience that I want to address. But before we do that, the last question we ask on these calls is one of, kind of taking yourself outside of your own business. If you had to take 3 steps back, what developments in the industry outside of what Figure is currently trying to solve for are you most excited about and interested in following right now?
So I that's hard for me to answer because I'm so myopic on what we do. If I wasn't running Figure and yields came to fruition, I would go all in building payment infrastructure off of that. And I think that has such huge application and cross-border remit. Um, you know, I I again, if I had my bandwidth, my druthers, I'd be going to some of the other regions and talking about standing up not a VASP, but an actual exchange for digital assets. And I think at some point someone's going to be willing to lean in and do that. One of the misrepresentations is we always have this panacea that there's different regions in the world that are crypto friendly. You can do so much. At the end of the day, they all look back to the U.S. And they look back to the SEC and what the SEC allows people to do. And so there's no panacea, but there certainly could be a sovereign willing to make the investment of standing up an exchange, not a virtual asset license that would have exchange reciprocity globally, and that would be really interesting.
Yeah, absolutely. Our first question here actually is a good follow-up on what I just asked. It's asking you, what do you think the biggest innovation in the space has been over the past year? And which innovation do you think will have the greatest impact in the following year, so next year?
So I MPC is older than a year, but MPC is a massively disruptive innovation for blockchain, especially for extension into TradFi, and it's not well understood. So most of the custodians use MPC, but they don't use decentralized MPC. So, like BitGo, for example, uses MPC, and you should because it eliminates the issue of key loss. It's much harder to hack. Like there's a bunch of reasons to use it internally. But where I think the real extension value of this is when you take those policy agents and decentralize them with an on-chain policy engine, and that I think then opens up this construct of effectively self-custody, but being able to transact across LLMs. And so that to me is super interesting because the pragmatic reality we have right now, the NASDAQ on Burst will run 250,000 transactions a second. Binance on Burst will run 1.5 million transactions a second. There is no blockchain right now that can run 200,000 TPS, right? And we can have arguments about this. A lot of folks would say no, they can do it with hardware, and SUI will say no, we're going to get there. But the reality is, right now, we're not there. And so the idea that one blockchain is going to encompass, it's the 600,000 TPS that Visa runs, plus the 250,000 NASDAQ runs, plus everything else, it's probably not going to happen. So you're probably going to end up with more than one L1 that is focused on particular verticals until that throughput problem gets solved. And so having more than one L1 necessitates a solution like MPC.
Absolutely. Next question here is on hash, the native utility token for the provenance blockchain. How are you thinking about hash's development thus far? Can you give us an update on that?
So we've had to be very careful to not promote hash for since the very beginning, since we launched Provenance, and the reason being is, I wanted to get the ATS from the SEC. I wanted to get the transfer agent and the RIA as well. It's public that there's an S1 for Figure that's been submitted confidentially to the SEC. It's absolutely public. There's an S1 for Figure Certificate Corp because you can see it on Edgar. And so, we made the decision that it was better to really focus hash as a utility token, and not so much as a way to play RWA. I think we're at an inflection point now for that, where we're looking at a circumstance like Ondo, where Ondo has an L2 governance token that has no economic associated with it, and there's a huge amount of enthusiasm around that, and they have I think a $500 million TVL. Well, we're putting 600 to 700 million of TVL a month on Provenance, and that is the real RWA story. And so, June, who built Provenance, is working with a couple of different agencies to start going to the native crypto community and telling that story, and and what can be built on Provenance and what can be levered around it because of the 16 billion of RWA TVL that's on there. And so I think not through the next 2 months, but certainly into early 2025, you're going to hear a lot more about it, and we think that there's a lot of enthusiasm we can build around it.
Great. Appreciate the update there. I think we have time for about one more. So right here, I have a question, which is asking for a little more explanation on something we discussed earlier, Mike, specifically around the challenges and limitations when it comes to tokenization efforts, especially if they don't, those assets getting tokenized aren't, natively on chain.
Yeah, I mean, again, the issue is there's sort of two problems that you have in this space. Well, one is this notion that somehow if I tokenize something, it becomes liquid. And the reality is liquidity doesn't happen unless you have ubiquity in market making. And so, tokenizing an office building in Topeka is not going to make it liquid. And in fact, it's going to be more expensive than just doing LLC interests. And that's really what you should end up doing. And so, but further, it just underscores the issue of if you tokenize the office building, even if it's not liquid, if you can borrow against it, it would have value. The problem is, I don't know that that token represents anything because the office building isn't on chain, right? And that disconnect is a problem. I don't know if that office building was sold both to you in a token form and to somebody else in a paper form. I don't know if it burned down. Like there's a bunch of issues that you have when you try to take physical or analog assets and tokenize them, or even digital assets, a security sitting at DTC. I don't know that the token that's supposed to copy that, that security hasn't already been sold. And so if you can't displace trust with truth, you're not going to be able to extract the value that blockchain brings.
Think that's incredibly well said and does a nice job putting a bow on kind of everything we talked about today. Mike, really appreciate your time. Everyone on the line, thanks for joining us here today. I know obviously it's an incredibly busy time within this space, but we loved hearing more about Figure, hearing more about how you're building, and moving forward, we plan on hosting even more fireside chats, talking to more builders, more innovators, and really, cracking open what's going on behind all the headline news and token prices every day. So thank you everyone again for joining. Mike, thank you. And I hope everyone has a wonderful afternoon.
All right. Thanks, everybody.